All right, so when a huge global event rocks the markets, how do you even begin to navigate that chaos? Well, today, we're going to break down a really powerful framework for traders. And just to be clear, this is not about politics. This is all about macro thinking, helping you understand the shockwaves, position yourself smartly, and, most importantly, how to survive. Okay, so it always starts with some kind of flashpoint, right? A new conflict kicks off, and boom, you get these immediate ripples sent across the entire globe. That's what sets the stage for a massive shift in how the markets behave. And that one event, it never just stays contained, does it? It explodes into a global macro shockwave. And suddenly, the entire landscape for things like energy, currencies, and what we expect from inflation, it's all completely turned on its head. This is what ignites something called a macro repricing cycle. Basically, it's a period where the market just throws out all the old rulebooks. All the old assumptions are gone, and everyone is scrambling to figure out what the new normal is. Literally everything is getting reevaluated. So here's our game plan for getting through all this. We'll talk about the global macro shock, and then we'll dive into a three-step process. First, how to identify the new regime. Second, how to trace the transmission of the shock. And third, how to calibrate your execution. We'll wrap it all up with a really critical idea, positioning over prediction.
All right, let's get right into it. The whole point here is to give you a disciplined framework, a real process for making decisions when things get crazy out there. It's all about helping you avoid those common traps and, just stay in the game.
Now, the core of this whole thing is a super simple but really powerful mental model, RTE. That stands for regime, transmission, and execution. So first, you identify the new regime. Then you trace the transmission channels. And finally, you calibrate your execution. Let's break down exactly what that means.
Okay, step one. And honestly, this is probably the most critical part. You have to recognize that the rules of the game have completely changed. If you try to play by the old rules when the market is in a new regime, well, that's just the fastest way to get yourself absolutely smoked.
And this really shows you the difference, right? In the old regime, it was all about technicals, charts, microanalysis. Well, in this new macro regime, you can kind of throw that out the window. Now it's the big headlines and huge global capital flows that are driving everything. Those correlations you trusted, they're broken. And volatility, it's not just high. It's probably here to stay for a while.
So what does this actually look like day to day? Well, headlines are what move prices now. The risk premium, that extra bit of return investors want for taking on risk, it just expands everywhere. And volatility, it doesn't just spike and go away. It clusters. That means you get a crazy volatile day and you should probably expect another one right after. All those little intraday patterns you used to rely on, they just don't have the same authority anymore. Okay, so we've identified the new regime. We know the rules have changed. The next big question is, how does this shock actually travel through the global market? We've got to trace its path, follow the money. One of the biggest channels is always energy. Think about it like a domino effect. A conflict somewhere important happens and bam, oil prices spike. That immediately leads to higher inflation expectations. Then, the bond markets see that and start pricing in higher interest rates, so yields go up. And what does that do? It causes a huge repricing in the currency markets. It's a really clear cause and effect chain.
And while all that is happening, you see this classic flight to safety. Money just pours into things like gold and the US dollar. And at the same time, it's rushing out of riskier places, like emerging market currencies. But here's a really key signal to watch for. Pay close attention to when those safe havens start to diverge from each other. That little divergence is pure information. It's telling you something really important about the stress that's building up under the surface of the system.
So, to keep track of all this, you need a simple dashboard. We're not talking about tracking hundreds of things here, just the vital few. You gotta watch crude oil. That's your primary shock. Keep an eye on the US 10-year yield for signals on inflation and policy. Track gold and the DXY, the dollar index, to see what risk sentiment is doing. And of course, you have to watch volatility, like the VIX, to get a read on the market's fear level.
All right, and that brings us to the final and maybe most practical step, execution. This is where the rubber really meets the road. In a market like this, volatile, driven by macro events, discipline is everything. It's literally what separates the people who survive from the ones who become casualties. So let me ask you a direct question. What is the number one most important rule you need to follow when volatility is exploding? It's this right here, and I really want you to let this sink in. Increasing your size when volatility is expanding is not trading. It's just gambling. Plain and simple. The market is giving you wider price moves, sure, but that means you adjust your size down, not up. You don't add more risk when the environment gets riskier.
In fact, let's make this a hard and fast rule. Let's say the market's average daily range, what we call the ATR, or average true range, let's say it expands by 40%.
Then your position size needs to come down by 40%. It is that simple. It's just inverse math. What you're doing is keeping your dollar risk the same in a much more dangerous environment. You absolutely have to respect the volatility.
It's also so important to know the difference between the two moves you see after a big headline. The first move is just pure chaos. It's an emotional knee-jerk reaction with awful liquidity, and it usually fades pretty quick. The second move, that's the real one. That's the structural realignment, when the big institutional capital starts to really digest the news. You want to avoid that first spike and trade the second, more orderly move.
Look, your entire mindset has to shift to protecting your capital. It's about survival first and making returns second. And that means you're probably making fewer, much more selective trades and maybe looking at higher time frames. Your stops have to be wider to account for the new volatility. And just remember this, every dollar you protect today is a dollar you have to deploy tomorrow. Capital preserved equals optionality. It's your ticket to stay in the game.
So all of this really leads to a huge shift in mindset. We're going to go beyond just tactics now and talk about a guiding philosophy for how you approach the markets.
Because here's the thing. Good macro traders don't try to predict what's going to happen next. They don't predict headlines. That's a fool's game. No. Their job is to figure out where the dominant capital flows are going and simply position themselves to be on the right side of that flow.
So, to wrap it all up, here's the new mindset. Remember, positioning over prediction. Start thinking in terms of massive global flows, not just little chart patterns. Know that preserving your capital is your single most powerful weapon. And always, always follow that disciplined process: regime, transmission, and execution. RTE.
So we'll leave you with this question to think about. Now that you have this framework, how are you going to take a hard, honest look at your own process? What are you going to change to make sure you're aligned with the market that is, not the market you wish you had?